The first principle we are going to discuss is the principle of insurable interest. Now, insurable interest is defined as an asset or potential liability as subject matter of insurance with which the insured has legal relationship that will lead to financial loss to the insured when exposed to a peril. Now, it's very easy to understand. Basically, we need to have an asset as subject matter of insurance, or it could be a potential liability, like we have third-party liability when we drive a car or two-wheeler, right? And the insured should have legal relationship with this asset. When he has a legal relationship with this asset, and when the asset is exposed to a peril, the insured will suffer a loss. Then we say the insured has insurable interest in the subject matter of the insurance. Like, for example, an individual has insurable interest in his own life. He has insurable interest in his children. He has insurable interest in his spouse. An employer has insurable interest in his employees. A creditor has insurable interest in the person to whom he has given the credit, right? Say, for example, I have a house. I bought a house taking loan from the bank. Now, bank will have insurable interest in the property. The bank will have insurable interest in my life because they have legal relationship to the extent of the loan when they gave loan to me for buying this house. So they have insurable interest to the extent of loan only, right? So basically, insurable interest is very important in the sense the insured should have insurable interest at the beginning of the policy, at the time of policy inception, and during the course of the policy period, and at the time of making the claim. Then only the claim will be admissible and the liability of the insurance company will be established. So, for example, I have a house and I have taken earthquake fire policy with earthquake extension covering the risk. Now, during the course of the policy period, I sell my house to some other person, right? After I transfer the property on somebody's name, there will be an earthquake and extensive damage will happen to the house. Now, just because I have taken the policy, I cannot go to the insurance company and make a claim because I cease to have insurable interest at the time of making the claim. I don't have insurable interest. Okay. Similarly, when you take a car with car loan and the car is stolen, the company, the bank or company whichever has given loan for purchasing the car will have insurable interest in the car, and the insurance company will pay directly to the bank that has given loan based on the bank clause and the endorsement. So, insurable interest is the fundamental principle guiding the insurance. We cannot take, say for example, I cannot take insurance policy on you and you cannot take insurance policy on me because insurable interest does not exist. Now, what happens? The legal problem here is, at the time of inception of the policy, if the insured misguides the insurance company regarding the insurable interest, fraudulently obtains the insurance policy, and at the time of making the claim, if the insurance company finds out the person did not have insurable interest at the time of inception of the policy, then the insurance company will deny any claim, settlement of any claim. So it's very important to understand that one should have insurable interest at the time of inception of the policy and through the policy period and at the time of making the claim. And it's also important to note that there is one exception for this. The exception is in marine insurance. In marine insurance, it is sufficient if the insured has insurable interest at the time of making claim. He need not establish that he had insurable interest at the time of inception of the policy and through the policy period. Just at the time of making the claim, if he has insurable interest, that is good enough and the insurance company will honor the claim.